All right, let's dive right into this explainer. Today, we're looking at the anatomy of a high conviction stock by breaking down 5 specific picks for July 2026. Look, if you're on the hunt for businesses that act like absolute money printing machines, companies with massive competitive moats, compounding cash, and clear, undeniable growth catalysts, you are definitely in the right place. So, here is our game plan. We're covering 5 distinct disruptors: Remitly, Double Verify, ServiceNow, Meta Platforms, and Mobileye. Let's get right into why these 5 are standing out from the pack. Starting us off at number 1, we have Remitly, the digital remittance disruptor. Okay, so Remitly is essentially the digital pipeline for immigrants sending money back home. Imagine a nurse in Houston sending money to Manila, or a construction worker in Seattle supporting their family in Mexico City. Remitly is completely eating this market. They're taking users away from the old, painful way of doing things, paying massive markups at sketchy local strip malls, and moving them into a fast, digital-first space with much lower fees. And here's why this matters. Remittances are literally one of the most consistent money flows on planet Earth. People simply do not stop sending money to their families, no matter what the broader economy is doing. Now, you might be thinking, couldn't someone just copy their app? Well, sure, a competitor could probably clone the interface in a weekend, but they absolutely cannot clone 15 years of complex global regulatory approvals. Every single country pairing is a massive legal maze, and Remitly has spent a decade building out that licensing web. Plus, they have the deep trust of almost 10 million active users. When you're handling money that a family literally needs to buy food, customers do not just jump ship for a 10-cent discount. Once Remitly wins a customer, they stick around. So here's the real kicker. Remitly went from burning cash back in 2021 to now projecting a whopping $283 million in free cash flow for 2025. And what are they doing with all that cash? They're actively buying back shares and aggressively raising their full-year revenue outlook to nearly $2 billion. Interestingly, they're even benefiting from new foreign remittance taxes. Those extra costs force users to cost shop, which drives them straight into Remitly's cheaper digital ecosystem. It's a massive tailwind. All right, moving on to number 2, Double Verify, the ad referee. Double Verify is this incredibly overlooked quality underdog. Think about it. When massive brands drop billions of dollars on platforms like Meta, Connected TV, or TikTok, they demand an independent third party to verify that the ad actually ran, that a real human actually saw it, and that it didn't completely torch the brand's safety. The platforms selling the ads, well, they have every incentive in the world to grade their own homework. Double Verify is the independent scorekeeper. They get paid on every single whistle to keep the whole ecosystem honest. And this is where their competitive moat gets incredibly deep. As AI agents start buying and placing ads at machine speed, having an independent verification layer becomes exponentially more valuable. Again, a platform grading its own homework is practically worthless. DV's moat comes from its absolute neutrality, paired with a massive data engine that analyzes billions of transactions every single day. The more it measures, the sharper its fraud detection gets. It's become a totally sticky piece of infrastructure, wired directly into the ad buying plumbing. Let's look at the financials here, because they are fantastic. This software company has zero debt and is literally overflowing with cash. They are projecting $173 million in free cash flow for 2025, with a massive 70% EBITDA to cash conversion. That basically means they are highly efficient at turning paper profits into actual money in the bank. Management knows their stock is cheap, too. They've already shrunk the share count by 4.5% in just a single year. So you just sit back and your slice of this growing, highly profitable business just gets bigger and bigger for free. Coming in at number 3, we have ServiceNow, the corporate operating system. ServiceNow is basically embedded into roughly 90% of the Fortune 500. They are, for all intents and purposes, the operating system of corporate America. When an employee at a massive corporation needs something fixed, approved, or set up, ServiceNow is the high-margin toll booth that request travels through. We're talking about a company that generated $1.67 billion of free cash flow in a single quarter, all at a 44% margin. That is absolutely wild. Their moat is completely defined by this staggering number, 98%. That is their renewal rate over 7 consecutive years. When 98% of your massive enterprise customers renew for almost a decade straight, that's not just customer satisfaction. That is complete dependency. Think about the alternative. Ripping out thousands of customized workflows means performing high-risk surgery on how an entire company operates. There's no guaranteed payoff for doing it, just massive operational risk. So they stay. And remember all that market panic about AI destroying software companies in a so-called SaaS apocalypse? Yeah, well, ServiceNow's AI suite is actually tracking to double its original revenue target. They are pulling in $1.5 billion in annual contract value just for their Now Assist product. They're also boasting 130% year-over-year growth in million-dollar AI customers. The narrative said AI would kill them, but the numbers show they're actually using it to dominate. Let's shift gears to number 4, Meta Platforms, the advertising juggernaut. Look, Meta operates at a literally planetary scale. We're talking 3.5 billion daily users across Facebook, Instagram, WhatsApp, and Threads. And recently, they pulled off something exceptionally rare. They massively increased both ad volume and ad pricing at the exact same time, absolutely destroying Wall Street estimates. Every business claims they can raise volume and price simultaneously, but almost none actually pull it off. Meta did exactly that. They generated $10.44 in earnings per share compared to a 6.66 expectation, all while holding these incredible 41% operating margins. So what does this mean for the stock? Well, the massive value arbitrage gap is super clear here. Meta is growing significantly faster than its peers, yet it's trading at an aggressive discount compared to the Magnificent Seven average. Think about this for a second. Meta is trading at a forward PE in the mid to high teens, meaning you're paying a relatively low multiple for its expected future earnings, while it's growing revenue at 33%. Meanwhile, Alphabet is trading around 31 times forward earnings, but they're only growing at about 12%. The faster horse is being aggressively discounted here, giving focused investors a really remarkable window. Finally, coming in at number 5, we have Mobileye. This is our 10x moonshot. This one is our most asymmetric risk-reward play. Right now, they supply self-driving chips, but Mobileye is rapidly pivoting into a full robotaxi operator. For those of you with a longer time horizon, this is the big potential moonshot. Here's the thing, you just cannot teach a car to drive on a whiteboard. Mobileye's insurmountable moat is their 2 decades of safety validation and the billions of real-world data points constantly being uploaded by their network. Through their REM mapping system, every single Mobileye-equipped vehicle on the road today is basically out there scouting and mapping the world for the entire network. A startup simply cannot replicate this without first getting their tech into millions of cars. And we are already seeing the validation. Their base business is re-accelerating and actively funding this massive physical AI platform, giving investors multiple ways to win across the whole autonomous mobility sector. Just look at the progress. Q1 revenue jumped 27%. Uber just highlighted them as a key tech partner. The VW MOIR program is already live. They are even taking their vision tech into humanoid robots through their Menti Robotics acquisition. You aren't just buying a car part supplier here. You are buying a foundational physical AI platform. Mobileye is making a huge transition from collecting a one-time chip royalty to owning every ride and fare forever. And every single date on this timeline closes the gap between their current stock price and future dominance. They're aiming to launch 100 fully driverless vehicles in a major U.S. city by 2027, scaling towards 17,000 vehicles shortly after that. As each of these target dates hits, re-accelerated growth in 2026, profit swings in 2027, and material robotaxi revenue in 2028, the market is going to be forced to reprice this business. So we've covered a lot of ground today. Based on everything outlined in this explainer, you really have a choice to make. Will you anchor your portfolio in the toll booth predictability of a company like ServiceNow? Or are you going to take a big swing at the autonomous, driverless future with Mobileye? Dive into the data, structure your own strategy, and decide what side of disruption you actually want to own. Thanks so much for checking out this explainer, and I will catch you on the next one.